Hi, I'd like to welcome everybody back to our Fast Fives from Thompson Wealth Partners. It's great today to be joined by Matt Forsdick. Matt is a senior VP with Brookfield Private Wealth. Brookfield Private Wealth are the owners of Oaktree. Oaktree is a fixed income manager that started in Chicago back in, what was it, 1996, Matt?
1995,
Oh,
based in
okay.
LA, actually.
Oh, based in LA now. And again, it is they're just a wonderful company. Their views on fixed income, as everybody that's a long time listener of mine, you know me, I love to listen to the fixed income people because I think they really tell you the route to go. We use Oaktree with regards to having some alternative assets in private credit. And private credit has had a bit of a bumpy ride recently. And so we wanted to get Matt on the phone to talk about, some of the conversations that we're hearing in the news, and what is fact and what might be fiction. Um, Anyways, we have a number of questions for Matt. We think it's important for people to understand what is happening out there. So without further ado, we'll ask Matt a few questions. Matt, the biggest question is out there, is private credit representing a systematic risk, a la 2008, 2009?
Yeah, thank you, Greg. And thank you for having me on for this Fast Five. The answer is no. We do not believe that is the case. We have seen some recent articles in the media comparing private credit to the 2008, 2009 financial crisis. We don't think that's fair. Just for some background, one of the outcomes of the global financial crisis was that traditional banks were saddled with more regulation. This made it more difficult for them to lend to these medium-sized private businesses. So they started to do less lending, and private credit stepped in to fill that void. In effect, the banks transferred this risk from their own balance sheets to private credit firms. However, there are some big differences here. For one, private credit firms operate with significantly lower leverage than the banks did back then, and that they even do now. The banks were levered roughly 30 times. Most private credit firms are maxed out at 2 times leverage, and most operate at 1 times or less. Private credit firms also have many guardrails in place, including redemption limits that are designed to stop anything that would resemble a run on the bank like we saw in 2008 and 2009. So we, for many reasons, do not believe that private credit represents a systemic risk. I just also want to add, the growth in private credit has been a good thing for corporate borrowers. It has provided an additional financing option for these businesses. Private credit is only going to continue to grow and become a more important financing solution in the global economy.
So, Matt, we talk about, risk and concerns. Are there any interlinked credit issues out there? Like we hear about these contagion. We talked about 2008 concerns. Anything like that?
Again, the answer would be no. We don't believe that private credit is infested with a lot of interlinked credit issues. To be clear, a lot of money has flowed to the private credit space in recent years. Anytime a lot of money and capital flows to any one space, typically what you'll see is some lending standards will fall, some terms might weaken, some deals will get done that frankly probably shouldn't have been done. And there are certain private credit firms out there that prioritize growth as much as possible, who likely did some weaker deals. And they may be exposed to more credit issues as they start to arise. However, so far, the credit issues that we have seen have been idiosyncratic events that have been limited to specific companies that are underperforming for one reason or another. There has been no broad contagion across the industry at all. And further to that, we do believe that the firms out there who prioritized, prudent credit selection over just growth for growth's sake, the firms who are more diversified, that are less levered, and that prioritized safety will be the ones in a much better position going forward.
So hearing that, one of the biggest things we hear in the press, of course, these days is about software companies. We, as equity investors, as well as fixed income investors, own a number of software companies. One company in particular that we are quite patient with these days is Constellation Software, which earnings came out yesterday. The earnings were great. Their gross margins were solid. But the stock is still down 50% from its highs we saw in 2025. Fundamentally, if we saw an issue with it, we would sell it, but the earnings continue to grow in line with our expectations. The private credit area has exposure, a lot of exposure to the software companies. Is it overexposed?
Yeah, that's a very fair question. So software is a major concern in the space. Software has driven a lot of deal flow in both private equity and private credit over the last few years. It's easy to understand why. These software companies generally have strong recurring revenue, they have high margins, and they have high switching costs. It's very difficult to get out of your contract if you want to change your software provider. All of these reasons made them very good businesses to lend to. Now, that thesis has been called into question with the advancements in artificial intelligence and the impact that this may have on some of these software companies. So investors are beginning to reassess their view of these companies and their valuations, which is why we have seen the value of many software loans falling in the public markets over the last few weeks and months for this exact reason. We here do think it is a mistake to paint all software loans with the same brush. Over the medium to long term, there will of course be winners and losers as this technology continues to develop. The losers will be the companies that are disintermediated from their customers by artificial intelligence. It is our job as prudent investors to lend to more essential, vertically integrated software businesses that we believe are actually going to be beneficiaries of AI. So I get asked all the time, will you ever lend to another software business? The answer is absolutely yes, but the bar has been raised. I should also mention, even if we do see lower equity valuations in some of these software businesses, a lower equity valuation still applied to a viable business does not mean necessarily a bad outcome for a lender. Most software loans are structured with very large cushions of safety beneath them, which will help us protect value and our investors over the long term.
I'm just going to jump in here. I just have one other question there. So with software side, you mentioned you're more interested in vertically integrated companies. Is there a reason you want the vertically integrated companies? Just stickier?
Correct. So if we kind of differentiate, by vertically integrated, I mean you have an essential software that is embedded across a company from top to bottom. Your essential, it's very, very difficult to remove from the business. I will contrast that with what we would call a horizontal software company, where you do one generic task that perhaps hundreds of companies can use you for. customer service, these types of industries might be good examples of more horizontal software businesses. In our view, it's the horizontal businesses that will be much, much easier to replace. And these are the types of software companies we have looked to avoid historically, and especially now.
Good.
So we've talked about the potential risks out there, maybe some rumored risks, and the validity of those concerns. However, we have seen redemption requests in the space. So how would you say investors should interpret those requests?
That's a great question. So all private funds typically come with limits on how much investors can redeem. They're often limited to 5% of the fund's value in any given quarter. And this is because the underlying investments, private loans in our case, are less liquid, and they cannot be sold immediately, unlike publicly traded bonds. It's this illiquidity and complexity that you do typically earn a premium for, and what you are compensated for as an investor. We do appreciate that these redemption limits can be uncomfortable for investors at certain times, but it is worth remembering that these limits are there in place for a good reason. They are there to protect all unit holders, in particular during times of stress, which is what we are seeing at the moment. Given the limited market for the underlying loans, we never want to be in a position where we are forced to sell at a loss just to raise cash. That is what the redemption limits help us preserve. So at Oaktree, we do take this very seriously. We typically have a little bit of a higher allocation to cash and public credit within our portfolios. We also typically tend to have lower leverage in our portfolios to always put ourselves in the best possible situation to give our investors liquidity.
So just to confirm, these safeguards are put in place when you sign up to undertake these investments, and they're more so there to protect the integrity of the whole portfolio. It's not like companies are just holding client money hostage, right?
Correct. Yes, these redemption limits are a feature. They're not a bug. They're there to ensure the value of the investments and protect all unit holders.
Right.
But recently, again, you've lowered your distribution from 8.5% to 7.7.
Yeah, about 7.8-ish.
And is that because of the redemptions?
No. So I will be very, very clear. The reduction in the distribution is completely independent from the fund's redemption activity. The reason for reducing the distribution is pretty simple. Private credit is a floating rate asset class. So while the fund benefited from the increase in rates that we saw through 2022, 2023, what we saw in 2025 was in the US, we began to see lower rates. At the same time, credit spreads, so the amount of spread you are compensated for by doing the loan over that rate, began to get smaller through 2025. The combination of lower rates and tighter spreads on the loan just quite simply made it prudent to adjust the distribution to reflect that new reality. I will also say here at Oaktree, we made the decision to keep our leverage on a fund level quite a bit lower. We have roughly half a turn of leverage on our portfolio. That's about half what many of our peers did. We did that because we wanted to be cautious and put the fund in a better position for this type of environment. So because we held our leverage a bit lower, that also impacted the amount of income flowing through. So if I look at the fundamentals of the portfolio, I'm actually incredibly pleased with how we're positioned. the portfolio looks incredibly strong. The reduction in the distribution is just simply the reality of lower base rates, tight spreads, and our stance with lower leverage.
So I'm always one, I've said this repeatedly over the last month. I'm always one to not let a good crisis go unused when it comes to investing. And what opportunities do you guys see from the recent credit issues? And is this something that Oaktree is going to take advantage of? Because that's why we hire guys like you.
Yes, and it's typically this environment that Oaktree proves its worth more than others. So we think this is actually a very interesting time to be a lender. The investment team at Oaktree, this is probably the most excited we've been in the last few years. We're now in a market where there is less money flowing to the space. Certain managers are facing higher redemption requests than others, and therefore they're not as able to be as active doing new deals. This means that the market today has a better balance of demand versus supply of capital than we've seen in the last couple of years. That makes it a much better environment for lenders who are in a position to go on offense. So while we have been a little bit more conservative in recent years, we are now in a much, much better position to deploy capital into new deals. So if we look at the market today, we are already starting to see spreads widening a little bit. That makes it more attractive for new deals. We think there could be also interesting opportunities for things like rescue loans or purchasing loans on the secondary market from our competitors who have good positions but may need that liquidity, which we talked about a few moments ago. So firms like Oaktree, who were quite prudent in terms of credit selection and their use of leverage, will be in a much better position to deploy. And that will be something that all investors will benefit from.
Yeah. No, again, the big reason why we went into private credit, and we just did it a couple of years ago, we always knew that at some point, if you're getting paid what we're getting paid from fixed income investments, we're taking more risk. And so volatility should not be a surprise to anybody. You're going to go through times like this. I believe, when you go back, it was just about 10 years ago that private credit, when it was more its infancy, went through a bit of a shakeout like this as well. And all the same conversations that we're having now, we had then, and it proved to be a really good time to do it. The reason we chose the time and chose you to use for our clients was because we were in a big bear market for bonds, and so covenants were much stronger at that time as opposed to pre-2022 when it was very much covenant light, so security wasn't as good on the debt. And B, we knew that this was a newer fund that had lots of liquidity, that if we went into this environment, that you'd be best positioned to take advantage of it. Doesn't mean that you're not going to go down a bit, and we've seen that. You guys are off to start the year, but the income continues to flow. Is there anything you'd like to tell investors at the end with regards to, what expectations should be as we go forward? And, you get the benefit of hearing from Howard Marks more than we do. Howard Marks is the founder of Oaktree and a legendary fixed income investor. I love to listen to what he says. I love to read his memos. For people that are listening to this, if you want to read interesting stuff, Google Howard Marks memos. It's a great read. But any closing words?
I would just echo what we've already discussed. We think this is an exciting time for the space. We believe we've put ourselves in a good position for that. When others are pulling back, we'll be able to go on offense. And typically the best investments, the best loans are made when things feel the worst. I personally believe a lot of the rhetoric is already overblown to begin with, but I have a feeling we'll be sitting here at the end of the year talking about a lot of the good things that we were able to do rather than talking about all of the negativity out there in the media. We're quite excited for 2026.
Well, Matt, that just means that we're going to have to come back to you at the end of the year and see where we're at. So our listeners, our watchers, our viewers, and we hope there's more than one of them, can see how things have gone. Matt, thank you very much for your time today. We really appreciate this. We hope the people that are watching enjoy the content, and by all means, give us a like or follow us, and don't hesitate to share this with others. Thanks a lot. And Matt, always interesting. I love talking fixed income.
Thank you, Greg. Thank you, Rob.
Thanks, Matt.